Let's talk about the intraday move yesterday.
Yeah.
Does the fact that we got down 2% or so on the S&P and rallied so significantly, over 1% into the close on Wall Street, suggest that valuations got low enough and it's time to buy?
I don't think so. Valuations are extremely stretched. I think the one measure people talk about is price to earnings. That's the most easy, most generic measure that everyone looks at. Market's not incredibly expensive on that measure. But if you look at price to sales, enterprise value to EBITDA, price to EBITDA, the market's never been more expensive at the end of September on those measures. We've come off 10% since then, but still incredibly expensive. Operating margins, profit margins, record highs, and I think that's going to turn the corner. The things that are making earnings look good is you've got record high profit margins, 10.1%, never ever been achieved before. And that's going to mean revert, we think.
And so the valuation point you're saying is relative to the fundamentals, which is, of course, crucial to view, that relative to the earnings outlook, as opposed to just the arbitrary point that the US market is overpriced relative to Europe. It's overpriced relative to its own fundamentals.
Exactly, yeah. 11 times price to EBITDA. It's just the market's never got there before, and the tech bubble didn't quite get there even. And that's where we were on September 30th. So we've fallen 10%. I think there's a very good chance we're in a bear market before Christmas, and it's another 10% to go. The market's still expensive even with these, basically, it's a 10% sell-off. It's an official correction now, but I think we get into an official bear, and the market still won't be cheap. My view is the economy is actually probably going to deliver as well as most consensus expects, so I'm not in the camp where there's a recession. But we've always had a put option. For the last 10 years, the central bank, the Fed's given us a put option. We don't have a put option from the Fed anymore. We're short a call to the Fed right now.
Are there pockets of value in the US market? Are there any sectors or stocks you do like?
The old-fashioned cyclical stocks, the stocks that people didn't buy to be bulletproof from the coming recession. We don't think there is a recession. Take cyclical risk when it's there. Those stocks are cheap. Buy a Disney, short a Netflix. Disney's trading at 15 times earnings. And people are talking about Netflix value coming from $8 billion in spend on new content. Netflix or Disney does that on 3 different movies, and it's got merchandising and music and theme parks. So much more diversified, much cheaper. Look for old-fashioned companies, take the cyclical risk, but sell the bulletproof secular growth that are the FANG companies, basically.
In terms of, for our US viewers, some of the stocks in Europe that you do like, that you'd suggest they buy, you like some of the European banks, which have often been quite scary
That's the most
touch.
Extreme. Buy the scariest parts right now, because we actually think the economic backdrop's going to be supportive. We don't buy into the coming recession. The stocks that are going to be hurt are the stocks that have the most duration. So companies like Amazon, a great company, but you've got to bet that what their earnings are going to be 15 years in the future when you're paying 100 times earnings. So as we get into the rising interest rates that are going to come based on the strong economy, you want to buy companies that are producing earnings now and not discounted future earnings. So companies like BNP, poor results today on the revenue line, but they weren't poor overall, I don't think. They're spending, creating a digitalized, lower cost structure going forward, and you're getting a 6% dividend yield, trading at 8 times earnings. So that's a company, you don't have to wait long for that earnings to pay back your share price. If you're paying 100 times earnings, that's a very long duration play.
Airbus over Boeing?
Airbus, that could be a real beneficiary from the trade wars if they really do emerge. So China's a big buyer from Airbus and from Boeing. If anything creates a pivot, excuse me, towards European companies, we think Airbus is a very cheap cyclical company right now.
Autos have been in the eye of the storm because of the trade war. Would you buy any of the European names? They've been hit hard.
All these companies that people are just scared to death about. The companies you're picking up at 6 to 8 times earnings, giving you a dividend yield of 4 and 5%. The end of the world's not going to come, but just don't be so scared that you're buying the bulletproof companies that are just way too expensive.